Hello and welcome to my YouTube channel where I break down the investing ideas, timeless principles, as well as the mindset of successful investors. One of my favorite things to do is to read books. I read a lot of books on finance and investing, and one of my favorite books is Common Stocks and Uncommon Profits by Philip Fisher. It's one of the most influential investing books of all times. It has influenced a lot of investors, including legendary investor Warren Buffett. The approach is on the people, the business culture, and the durability. And the principles are more applicable today than ever before. Markets change, right? Investing environment changes, technology changes. Look at the internet boom of 1990s. It changed basically everything, right? Anything you can think of can be found online, right? And that is one of the examples of this book where the principles are applicable in today's world. The book teaches you how to think like a long-term investor rather than a stock picker. And there are three main lessons that I would like to share with you from the book. Number one is called Scuttlebutt Method. What that means is instead of focusing on the financial statements or analyst reports, focus on the quality of the information you can get about the company. Talk to the people that actually know the company. Talk to the employees, the customers, the vendors, the suppliers to get real quality information about the company. But the other ways you can also still get that same quality information, right? Get online, whether the Google reviews, see what people are saying, whether it is Reddit or online forums, Glassdoor, right? Or, think of this example, right? When you go on Amazon and buy a product, what are the chances that you would buy a product that has like 1 star, that has like lots of negative reviews, right? Almost zero, unless that's the only product on planet, and that's very rare in today's investing environment, right? And the other idea is the management quality. Fisher emphasizes the integrity, the smart capital allocation, the long-term thinking of the management, right? The people running the business, do they have the best interest of the company? Do they think long-term about the company? Or do they only care about the quarterly numbers, the quarterly reports? Like, do they care about the stock price of the company only, right? It's a huge distinction there. And so you want to focus on the quality of the management. And investors pay hefty premiums for good quality management. Look at Tesla. Look at Palantir. They're trading in hundreds of Ford multiples. Like their PE ratio is in hundreds because investors realize the value this management brings to the table. Actually, another example is when Starbucks hired Brian Niccol. the previous CEO of Chipotle. Starbucks stock price shot up, went up 20 to 25% immediately. And in the meantime, Chipotle stock plummeted. That tells you how investors value the management. The last one is long-term versus short-term noise. This is actually one of the golden examples of why this book is still applicable, right? Like, listen to all the successful investors. They will all tell you to focus on long-term thinking, long-term investing, not short-term, stock prices, not short-term, like none of short-term thinking, right? That is one of the principles from the book, right? Fisher advises you invest in companies that will have compounded returns over years, 10 years, 20 years, 30 years, right? Remember, if you need to check the stock price of a company every day, that means you truly don't really know the business, right? You don't know the in and out of the business, Otherwise, you would relax and sit back and just let it run, right? So that is very important, right? To think long term instead of short term. Unless the thesis changes, the fundamentals change, you don't even want to worry about the stock price. You don't even want to look at the stock price of a company. I was reading the other day, there's some comments and reviews about the book, and I noticed there's some misconceptions about the book. Actually, there was some people have the misconception of that Philip Fisher never sold any stocks. That's actually not true. He just wouldn't do emotional selling. He wouldn't react to a stock emotionally. He would sell a stock if the thesis, the story changed, like if the fundamentals change. Otherwise, he would not sell. The other one was the Scuttlebutt Method only works when you have insider information. That's actually not true. You can have the same publicly available information that's public to everyone. It depends on you how you filter that data, that quality of the information, to make an informed investing decision that's sustainable in the long term. To sum up, the book teaches you how to think like a long-term investor, not a stock picker. And that's where the value is at. Please remember, this is only educational, not investment advice. If you like to see more topics, if you want me to create more videos, please leave a comment and mention what you would like me to discuss, and please provide any feedback you have, and I look forward to seeing you in the next video. Thanks for watching.